America just lost its AAA credit rating again. If you're thinking, okay, so what? You're not alone. Credit ratings sound like accounting jargon. But this isn't just about paperwork. It's about trust. It's about whether the world believes the United States is still the safest place to put money. About 2 weeks ago, Moody's, one of the three major credit rating agencies, downgraded the United States credit outlook. It wasn't a full downgrade to AA like S&P did back in 2011, but it was a warning shot. And it came with a scathing message. If Moody's had any credibility, they would not have stayed silent as the fiscal disaster of the past 4 years unfolded. That's a quote from the White House. They're calling this downgrade politically motivated. And sure, maybe it is. Moody's chief economist Mark Zandi has been publicly critical of Trump, and that's added fuel to the political fire. But here's the thing. The numbers don't lie. Moody's flagged something simple. The U.S. is spending way more than it brings in, and it's getting worse. Federal debt is projected to rise from 98% of GDP in 2024 to a massive 134% by 2035. And that's a problem. Even more alarming, interest payments alone could eat up 30% of all federal revenue by 2035. That's up from 18% today. So think about that. 1 in every $3 the government collects is there just to pay interest. And yet, Moody's didn't go full doom and gloom. They emphasized two pillars still holding up America's financial credibility. The United States dollar, still the world's most dominant reserve currency, and U.S. institutions. They're betting that governance, courts, and checks and balances will keep functioning. But here's where it gets real. The market doesn't wait for the government to get its act together. Investors are already reacting. What happens when the risk-free asset, United States Treasuries, start to look a little risky? You get what's called panic rebalancing. That means investors start looking for safety elsewhere. And one of the oldest forms of safety is gold. We're already starting to see a shift. Gold prices are creeping upwards, so are investments in commodities, ETFs, foreign currencies, and even crypto and Bitcoin. It's not about immediate collapse, but it's about hedging from what might come if the United States doesn't fix its balance sheet. So, who still holds a pristine AAA rating? Right now, it's a small but pretty elite club. Australia, Canada, Denmark, Germany, Luxembourg, Netherlands, Switzerland, Norway, Sweden, and the European Union as a whole. Back in 2008, just before the financial crisis, there were 16 to 19 countries with AAA ratings. That was the peak. Since then, it's been downgrade after downgrade. Even Japan lost its AAA rating, first from Fitch in 1998, then from S&P in 2001. Since then, Austria, Finland, Ireland, France, Spain, the United Kingdom, the United States, and most recently, Canada from Fitch, all downgraded. But let's zoom out. The United States isn't even the worst offender when it comes to debt. The top debt to GDP countries in 2025 looks like this: Sudan, Japan, Singapore, Greece, Bahrain, Maldives, Italy, the United States, France, and then Canada. Japan is in the lead at over 250% debt to GDP ratio. It's high up there. But it is important to note Japan's debt is largely held domestically. That's an entirely different risk profile than the United States, which relies heavily on foreign investors. Now, can the United States recover its AAA rating? Short answer is yes, but it takes discipline. Several countries have lost their AAA rating and earned it back. Australia, Sweden, Finland, and Canada have all done it. But what did they do? Fiscal consolidation, bipartisan commitment to long-term reforms, and strong, stable economic growth. The United States could follow that path, but it would require making tough choices that, well, let's be honest, few in Washington want to touch. And why does this all matter? This isn't just about America's borrowing costs. It's about the foundation of the global financial system. When the most trusted borrower in the world starts flashing warning signs, capital moves fast to gold, to other currencies, to new systems entirely. And while the dollar isn't going anywhere soon, credibility isn't infinite. Reputations take decades to build and a few political cycles to destroy. So yes, America's still standing. The dollar still rules. The treasury market still functions. But if you're watching this thinking, it's just a downgrade, think again. It's a signal, a siren, and just maybe a second chance. Because history shows that we can recover the AAA rating. But history also shows if you ignore the warnings too long, that recovery window can close fast.